my good friend Admire Mudangwe. I don't know how much you heard there, but he's a venture partner at Impi Capital Ventures, which is a venture builder and an investor that actually helps startup founders to scale their business and corporates looking to build innovative business models as well. So he's here to share with us about unicorn hunting. He was actually previously a vice president at JP Morgan as well, where we actually worked together, and he was responsible for accelerating growth and innovation strategies across Europe, Middle East, and Africa as well. So he's a very experienced business person, and especially around the topic of unicorn hunting.
That is really a pleasure to be here, and particularly speaking to the people of faith. And it's humbling to see that you guys do this kind of thing regularly. May the good Lord bless whatever you do. So being that you are the people of faith, my conversation with you becomes a lot easier. Number one, because you understand the biblical principles with regards to investment. When God, in the book of Genesis, God's creation was in twos. It was not in ones, number one. Number two, then he then says, let everything multiply. He did not say let everything add. So God is a God who loves multiplication, all right? Number three, you then also understand, the parables that Jesus gives with regards to the people that he gives talents, and some decided not to make use, some made use. Those that did not give an optimum return. It was taken and given to those that were better fund managers, in our language. So Christ himself actually taught us investment, and we should take the scriptures, not as just a religious book, but as a book of life, i.e. the principles that we should use in our daily life. And I'm so encouraged to see you guys, coming together to do this kind of thing. So my talk today is going to be very straightforward. So my talk is unicorn hunting, how to invest in startups. Alex has spoken a little bit about what we do. We conceive, design, and build and scale innovative products and ventures. So quite literally, we help founders create companies. And it's a team that has got wide experience from different companies, your Googles, your Facebooks, JP Morgans, etc. That's just what we do. And in terms of some of the companies that we have helped, there are some of these brands. So Natural by Livy is actually launching in the next few weeks. It's a natural and skincare e-commerce product being done. The oils are actually coming out from Tanzania and to be sold right here. And then we have got a Bear and Bry, with a mental health tech, a prop tech, a fintech, and a marketplace venture. So those are some of the companies that we have helped. Kicking off my presentation, what you find out is that there is the diamond and the diamond mine. I use this narrative quite a lot in that, one is an extract of the mine. And it characterizes to me two types of markets, being that we are here in the UK. For most of our audiences, I know that there are others who are dialing from elsewhere. The BME consumer market in the UK is worth over $300 billion. So that's the consumer market here in the UK. And the BME population has doubled in the last 30 years, and it is expected to double again in the next, 20 years, 25 years or so, by 2045. So why do I say this? To me, this is what is called the black diamond. That's the UK market, black type market, BME. I just, bucket it all together in there. So when you are looking at it, it shows that by 2045, we should be around 750 billion as a market. That's how much money we will be, spending as a growing consumer market. So that tells you that there is a growing trend in this particular market segment, and it's a growing addressable market that, if you are smart, you should start tapping into. Then we talk of the mine itself, the diamond mine, because these diamonds are actually coming from this diamond mine, and that diamond mine is Africa. Africa's population is projected to more than double by 2050 to 2.5 billion, of which under 25 will constitute about 60% of that population. Why is that statistic important? That statistic is important because it tells you that consumption is going to be on the rise. When you've got a young demographic, people who are starting family, their propensity to spend and desire to spend is much more higher. So I was just emphasizing on why this statistics is important. It is important in that it is showing you a growing market, which means growing spending ability and power. That's why you see a lot of brands are actually wanting to have a presence or a franchise on the continent because they see these numbers. And it will be naive or foolish of us, people who come from that heritage, not to take benefit and or advantage of this growing trend. Now, having given that bit of a picture, you would find out that for the Black founders, Black-led startups, only 0.25% of us receive capital from VC or venture capital firms. And that is a massive problem, which means that it's highly unlikely for us to venture out on our own because no one backs us up. You are going to see why this is important. Now, talking a little bit about the African narrative, what I talk about now is what I'll say Scramble for Africa 2.0. 2.1 happened, 1.0 happened, back in the day, where we are told stories of countries being divided up because someone was given a mirror or someone was given sugar or salt, those kind of things. And, massive tracts of lands were taken. But today, there is another scramble for Africa that is happening. If you're talking of infrastructure, you have China that is playing a very dominant role there. If you're talking data and e-commerce, which is what you guys all understand, you see who the biggest players are. Twitter is telling you that we want to have a presence in Africa. They have got a African head office in Ghana. Google coming up and saying we want to invest 1 billion in African startups over the next 5 years. You've got Stripe, an American brand acquiring a Nigerian fintech company. You've got Facebook, coming and saying we want to connect 1 billion people in Africa. You've got Amazon investing $280 million in South Africa for a head office there, which I think employs, they want to employ 7,000 people plus. It is not for the love of Africa. It is because they are seeing an opportunity, and that opportunity is within e-commerce and data. Data is the new gold or the new diamond. And these companies are seeing that and they're jumping on that opportunity. So it is already happening. And if we don't take advantage of this, our children and our children's children will blame us. Now, having painted that picture in terms of what is happening at a macro level, I then want to go down into the startup life cycle. So the startup life cycle is divided into 5 phases, or 6. The initial one is the pre-seed, just like when you're planting a seed, still an idea that you have in your hand. And then the seed is when actually that idea has been planted and is grown up. Then that plant begins to grow and mature, which is what we call Series A, Series B, Series C, D, E, F, in these days up until public. You go public. you go listed on the stock market. So those are the phases that a startup goes. Now, I have spoken earlier on around the 0.25%, and here's where it comes in. When you are at a seed level, it's still an idea, a concept that you have. Normally, the people that comes to back you up at that level is the family and friends, or is your own savings that you have. But in the wider VC community, is mainly the angel investors. The challenge that you and I have is that when it comes to family and friends, our family and friends, they're also scraping, which means that they don't have, 10,000, 20,000 that they can easily write a check and say, "Hey, Admire, I like the idea that you have, and I'm gonna back you up. Here's 20,000 check. Leave your job and start doing this kind of thing." Bootstrapping is massive challenge because we don't have a lot of savings, right? We are still sending Western Union and World Remit back home to support home as well. So it becomes very difficult for us. The angel network, there isn't much happening. So in terms of the ideas, there is a lot of ideas, good possible ventures to the people that I'm talking to right now, but they die right at the very initial stage, which is what I call the founder dialect. That's what the problem that we have. And then from there, you move on to a minimum viable product because you've used that angel money to build your MVP. At that stage now, you've got angel investment, again, coming up, writing up to $250,000 pounds. And then you've got venture capital now, serious money, which again, I've raised that, for the ethnic minority founders, we struggle. We only have got 0.25% chance of actually being funded. And then, which means that it is very difficult for us to move beyond the MVP or if, a stage at all. So it is not the lack of ideas, it's not the lack of seeing opportunities, lack of ability to execute, but our back is literally against them. And therefore, we cannot start the next big companies because of that. Now, what is a startup? Because not every business is a startup. A startup definition is actually defined as a disruptive, innovative. So those are the key words. It is going to be disruptive, it's going to be innovative, and a high growth potential company. High growth is very important. So just not a family business that you're trying to run. And then when we are looking at unicorn, what is a unicorn? A few of these brands, or many of these brands you're familiar with, the Deliveroo, the Monzos, the Wise, the Revolut, the World Remit, some of them you have actually spent money to enable them to be unicorns. On the other side, you have got Flutterwave, Cheaper, Jumia, Fori. These are actually African unicorns that have emerged in the last couple of years. And a unicorn is any startup that is worth over $1 billion. So these are the unicorns that we do have, that we know of. And in most cases, they achieve this feat within 5 years of being started. It does not necessarily have to be a tech business, because you can see there is Brewdog here. It's actually a beer making company, So I just put it there so that you see that it doesn't necessarily have to be a tech business, but your tech businesses scale much more faster than non-tech. Now, when investors or early stage investors are investing, they are looking at the long term. They are not doing this for the short term. So they are looking at anything between 7 and 10 years for potential exit. So they're in for the long haul. And I guess that's the discipline that we need to start having in our community, a long-term investment mindset or view. So that's important. And then, I'll share with you, the bad news first. The bad news is that 90% of startups will fail. It's given. That's the bad news. So that's the reality. But here's the good news. The good news is that one moonshot, one startup that you can back up can potentially return over 1,000 times of your investment. So out of 5, you just need one to return money. You just need one startup that will blow the charts and it will return your investments and much more beyond. So the idea therefore then is that you need to spread your nest. You don't need to put all your eggs in one basket. That's the notion. That's what VCs do. So they spread their investment across multiple startups that they will back up. Now, talking to you guys, where the opportunity exists is not when the company actually lists. It is when the company is still at a pre-seed stage that we spoke about that time, where the entrepreneur still has got a concept, an idea, they're still trying to piece things together. If you're able to enter at that level, that business still has got a 0x, i.e. 0 to 10. Like Apple, if you had invested in Apple there, you'll be talking of over 1,000 times your return on capital. Microsoft, Facebook, Twitter, etc. So it is timing that is important at the right level, at the right stage. Equities are good, but equities is late stage investment. So the question then is, okay, I understand the investment opportunity. I understand that I could possibly get a lot of returns, but then how can I actually make it? So there are a number of options. Number one is what I call loan hunting. You just go out there in the woods, look for a startup or startups that you jump by yourself. It's a good strategy. The good thing is that your catch becomes your own catch. You are the only catch, and you enjoy the feast by yourself. But here's the thing as well. If you're caught in there, you can also lose your life because you're by yourself. You don't have coverage. The other alternative is crowd investing, or what I'll call crowd hunting. This is common, you've heard about it. There are a number of platforms that are out there that exist that allows you to jump. So you're just jumping on the masses and backing those businesses, following the crowd, as it were. But then there's what I'll call pride hunting. Just a select few people who have got the opportunity of choosing their own target, covering each other's back, and then they aim for the target. It's not a big number, but it allows them to enjoy the feast in a relatively small number. And in terms of risk mitigants, they still have got their risk mitigated because there are few packs that is going after that hunt. Then what does that mean actually in real terms? It means investment syndicates, or some of you could have possibly heard angel clubs or angel networks. So it is an investment vehicle that allows investors to co-invest with relevant and reputable investors, leaders. So you need one person or organization to go and look for deals, review them, and then invite the rest of the pack to say, hey guys, we have found a good target. What do you guys think? Do you like it? Do you not like it? Then you have a syndicate. You invest as a pack. You are reducing your risk in that manner. The benefit that you actually have is then shared in the next slide. So what does that mean? So like I mentioned, syndicate, that you have a grouping of people, pool the resources together. You then decide to make your investment commitment to say, okay, fine, I'm able, or we are able to invest, say, 10K per year, or 10K per startup, as a grouping, or any other number. And then you find a syndicate lead who originates the deals, reviews those startups, perform early due diligence on them, and then you have got an opportunity to actually review the deal memos in detail, and also then have demos or investment pitches from the said founders, your Dragon Den style. They actually come and pitch to you. And then you decide to say, look, do I want to actually invest? I don't want to invest in this. If you decide to invest, you then invest in a special purpose vehicle that you create as a syndicate specifically for that investment. And then from there, you receive, investor updates directly from the founders. And then you look forward to exit. And in terms of exiting, you could exit when the company gets sold, or when the company gets listed on the stock market, or you could do what we call a secondary exit. That's most popular with a lot of angel investors. They do what is called a secondary exit. Now, being that you're in the UK, there are some advantages actually that the government has, some government schemes that it has to help reduce risk for investors and encourage a lot of investors to invest in startups. So you get some tax breaks. If you invest up to £100,000 per year, and you receive a 50% tax break in return, in what they call an SEIS, early stage company. And then an EIS is a medium-sized company where you can invest up to 1 million per year and receive a 30% tax break in return. So if the accountants in the room, they understand, the benefits and advantages of these tax breaks and everything else. If that investment packs and that startup fails, you will receive your tax break again. So that's the benefit that you have. I'll let your tax advisors, talk through to you more around those things. Now, we know this proverb: if you want to go fast, you go alone. But if you want to go far, we go together, we join hands. So think of how you can invest more as a pack, as a syndicate, if you want to invest.